Hello, hello. Good morning, everyone. Welcome in. Mic check. 1 2 1 2 1 3 2 1 5 6. Let's freaking go. Hello, hello. Welcome, friends, to Alpha Beta Soup. It's your boy, TXMC. Welcome to a world where Bernie Madoff style criminal Sam Bankman Fried gets only 25 years in prison for stealing billions of dollars from people, and Ross Ulbricht has 2 life sentences. Make it make sense. This is our world. Ross Ulbricht created a business that no one had ever seen before, that challenged the establishment, and his sentencing was a message. He is serving double life plus 40 years for creating the Silk Road over a decade ago. SBF literally predatorily stole billions of dollars from his customers and then lied about it, and he got only 25 years. Just a simple financial crime. Make it make sense. Welcome, everyone. We've got a few things to talk about today. We'll talk about the markets a bit. We'll talk about CPI and some very interesting comments out of one of the Fed governors yesterday that goes with some of the messaging we've been talking about the last couple streams about how inflation might be picking up a little bit, about how the Fed will find it difficult to make a good argument to cut rates this year, even though Powell sounded very optimistic and very bullish at the last FOMC meeting. So we've got a few things to talk about. Make sure you have smashed that like button if you have not done so already. It's the best way for you to support the channel. Everything you'll hear today are purely my own thoughts. This is just for information and entertainment purposes only. Do not invest based on my personal research. But thank you for being here. This news about SBF just dropped. The sentencing came out just in the last few minutes. So I've been reading the story right before the stream started. And yeah, I mean, I can't say I'm surprised that he didn't get some massive sentence. It's just par for the course in this absolute clown car of an economy, financial world, system, whatever. This clown car civilization we live in makes perfect sense to me. But let's turn our attention elsewhere. All right, let's talk about the markets a little bit. Let's go check on Bitcoin this morning. After a few days of consolidating under the all-time high, really most of March, kind of bouncing around this level, it looks like maybe we are constructively turning the prior all-time high into support. Now, it's still early. We'd like to really confirm it. We'd like to see action get above this high and continue on, of course. But this is nice to see. You got curling action. It set a higher low, and now we're back above that level, and we've got a bounce. These are 6-hour candles. So the structure looks favorable. Bulls are hoping for continuation. It looks pretty good. Yesterday when I was watching this move develop, we'd seen a pullback. You know, it was this drop right here created a bit of a flush kind of around the market. And I was watching breadth indicators. So I've got this momentum breadth indicator here. And I was waiting for it to this is on a 6-hour. Sorry. Let me switch down to the 1 hour. Here we go. Yesterday, during this flush right here, which is this candle right there, during this move down yesterday, as we approached the 200 MAs for the total crypto cap, I was watching the momentum oscillator here. This is our breadth momentum oscillator. It shows coins advancing when it's rising, coins declining when it falls, and it tracks the top 40 coins. So you get a good overall view of the market and how much of it is participating, how much of it isn't. And I really like watching this for confluence about levels either being penetrated or turning into support. Like right here, you can see a bit of a bullish divergence forming here where we have higher lows while we're still forming the low here on the total crypto cap. That was showing we had better momentum, fewer coins declining on this move down right here. And then obviously it put in the curl. And yesterday, during the development of this pullback, where were we? Let me put the replay on. We were like right here. Oh, is it going to do it? Oh, I can't do replay mode because of my custom indicator. Okay, whatever. We were like right here yesterday. And I was watching to see, okay, we're starting to see momentum curling. Let me get rid of this. Curling here, right? The blue line is faster than the red line. And once it curls back higher, similar to a MACD, which follows 2 moving averages of price, this moves kind of the same way. So once I saw that curl form around this area here as it bounced off the 200 MAs, I said, okay, maybe we're putting in an actual durable local low here, right? Because of the structure on the momentum oscillator itself, higher lows, and then we've got a curl in the 1 hour. So then it's like, okay, let's watch that roll up into higher time frames. So in an ideal world, if this works out, if using this indicator provides the signal that I expect it to, then we would think that as we move up time frames, now we're up to a 2 hour, that we would start to see this curl confirm and kind of roll its way up, plague the higher time frames. That's what we ideally like to see. Now, maybe there's a back test, maybe there's another back test of this MA right here. Maybe it's not that deep. Don't really know. I'm not that zoomed in on it. Just kind of giving you some of my thoughts and showing off this kind of cool indicator that I like to play around with. But my trading went pretty well in March. I haven't taken any new positions today. I'm still holding a long on Rune that I took a few days ago, or I think I got in a day before yesterday. I'm still holding a long on Rune, trying to target higher up here. I'm going to sell up in this area, but I didn't take any new longs today. And I just want to close up March successfully. I had a really good 3 months to start the year for my personal P&L. And I just want to lock in the quarter end today by not taking any new positions, just managing my one, go enjoy the long weekend, and come back next week refreshed, ready to start Q2. That's just kind of my approach today. So even if this, curl gets put in, Bitcoin pumps higher, that'll be great. It'll be great for my spot bags, which I'm still holding several of, including some BTC for long-term hold. But I've got several alts that I'm still holding to go higher. I've got some ETH, I've got Doge, I've got a bunch of other things. So I'd like to see that continuation play out. But really, this has been a long consolidation, and we talked about this, right? We looked at the breakout around the all-time high in 2017 and how there was a pop higher, a pull back, just like we got here, right? Got a pop higher, a pull back, and it was like a month. It was about 25, 26 days from the low of the pullback after the initial all-time high break until it reclaimed the all-time high back in 2017. It was about 25 days. Well, this was a lot faster. This was about a week, 8 days. So we'll see 7 or 8 days. We'll see if this will do it. Maybe this is all she wrote. Maybe it chops around some more. Maybe we get some more of this shit. Who knows? It's Bitcoin, right? BCB's in the chat. What up, bro? Welcome, welcome, welcome. What platform am I using for futures trading? I've got a few. Well, my platform. Well, these are my charts, but I trade on a few different exchanges. I don't recommend any exchanges because I don't know enough about their businesses, and it seems like every cycle, half a dozen of them go under, or at least one of them steals a bunch of money from people. So I'm really reticent to recommend any exchanges. I trade on several. I have accounts on Coinbase, on Bybit, on Femex, on Prime XBT, on KuCoin, and I'll mix and match them. The vast majority of my trading is on Bybit and Femex, my futures trading, and most of my spot exposure is either done through on-chain dexes or through like Coinbase. So that's like those are the kind of tools of the trade for me. But I don't use a trading platform right now. There's a couple I've tried out, but they don't use all of the exchanges I use. So I'm still like, if I use if I use a platform like Sandwich Trading, or I use In Silico Terminal, two really good crypto trading platforms, they don't support all the exchanges I have accounts on. But they do support Bybit, they support Binance, and I just haven't tried them out enough to be familiar with them or to recommend them or anything like that. So I just use the websites for the exchanges. So checking in on the Russell, this is one of the pieces that we've been monitoring for the last few months. You know, we've talked quite a bit, and with BCB here in the chat, I know some of you follow his content really closely. He's done some really great work talking about the Russell's role in expansions and how typically when we've put in a bear market bottom and equities turn higher, usually small caps represented by the Russell go along with it. They tend to perform really well. They bounce when the bounce is in, and they rip when things are going well. But what we are seeing, what the difference has been this cycle, is that small caps have been underperforming. They've been largely, right? This is their high from 2021, November 21. We're still way down here, right? Whereas the NASDAQ looks like this. So the Russell has been underperforming. And, a few weeks ago, we did a little bit of kind of loose TA on this, and we identified, well, there's this structure here, and then we broke down below it, and we've spent a long period of accumulation here. Some great Wyckoff structure forming. Here we are at sign of strength, and now it looks like we might actually be breaking out of this zone. Now, did we make a new high? We sure as heck did on the Russell. Look at that. Breaking above the prior high of this little range here. This was the high from March of 2022, so 2 years ago. Where is this on the retracements? Let's take a look at that. Retracements, fib 702. Let's get these lines off of here. So we're right at the 618. We'll see how this goes. So I'm not going to get super excited just yet. And the reason is that conditions have not changed for the small caps. So everyone is bullish. The market is going higher. The Fed was dovish at the FOMC meeting, but interest rates are still 5.5%. Fed funds rate is still 5.5%. Borrowing is still very expensive for debt-strapped companies, and small caps tend to be more reliant on debt to grow their businesses. They're not as cash fluid as the large caps. And what have we been seeing this whole cycle? Outperformance by cash-rich companies. Large caps outperforming. Small caps getting fucking pummeled. So we're seeing a pickup here. It's very late for this to be happening. It's kind of weird that the Russell is suddenly waking up now after it's ignored the expansion of the larger indices for the entire last 15 months or so. This is weird. So I'm a little cautious. It's great to see it. Don't get me wrong. Don't mistake me as just doom and gloom all the time. There are reasons to be cautious. And the main reason is conditions have not changed to make small caps have a better profitability outlook, right? The consumer isn't getting stronger. Rates aren't going down. It's just that people are getting more bullish. And so that's, in my opinion, that is part of what's driving some of this move, and the fact that this is one of the few remaining places for alpha, right? I mean, what are you going to do? Buy NVIDIA at $950 or whatever the fuck it is? You're probably going to look for alpha elsewhere. These are laggards, and so some of that play, I think, is coming into action here. But great to see small caps picking up. I love to see that. There will be a lot of eyes on this. People will be talking about how there is now expansion in the market. We're finally seeing breadth. This is a healthy economy, yada, yada, yada. But I will withhold my judgment for a little bit longer on what this means, because for all I know, it could just run out of steam right here. There's no reason to think it can't do that, right? It's certainly plausible. It's taken forever to get any kind of a retracement on this chart. This is the first attempt at any kind of a retracement. Now, maybe it does like Bitcoin, and the first attempt at a retracement, it just goes all the way up. But we'll be a little cautious. I don't have a position in the Russell. I don't really care. But So I don't feel compelled to have like a real strong bias on it. Just kind of my thoughts there. Let me check on what's going on here in the chat before I continue on with the next section. So we got BCB in the chat. Brandon Hammond gifting a membership. Thank you, bro. Oh, you know what? I totally forgot, guys. I totally forgot to mention this. We're going to do a member stream today. We're going to do a member stream after this. So we're going to talk for another, 30, 45 minutes or so. We'll wrap it up. We'll take a little break, and then we'll do a member stream right afterward. When we get closer to the end of this stream and I have a general idea of when this will end, I will book the member stream time and it'll show up on your timeline. I forgot to say that in my intro, but I've got it already ready to go. You can see over here, I'm scheduling it. I'm planning it. Members only. It's ready to rock. I just haven't sent it through yet because we're still going through our public stream here. How do I use Bybit? Well, Bybit doesn't support US customers, so you have to use a VPN and you have to get a business setup to allow you to trade internationally. There are countries that will provide you with a valid identification in their jurisdiction that is accepted at some websites. I'm not going to share that here with the audience today because I don't want to give bad information to people. But if you do some research and you decide that that is within your acceptable levels of risk, because there is absolutely risk in doing that, then you can proceed. And it's pretty easy to find this information. I'm just not going to link it and make it as easy as pie. You're going to have to go dig for it yourself. But you can get an ID that is accepted by some crypto exchanges. It's not a US ID. It is a valid government ID. It's not illegal to do that, and it will let you trade on Bybit. But again, I'm not endorsing it, and I won't provide the link. You can do research. Just know that it exists. XP Market, member for 3 months, the Founders Club, the OG. Says, hey, TXMC, I just want to say thanks for all the effort you put into Alpha Beta Soup. Your streams, especially diving into the tough stuff with such chill vibes, really makes my day better. That is such an awesome message. Thank you so much for saying that. It means a lot to me. It does. That you find value in the streams, you enjoy what we talk about, that you enjoy the tone that I deliver the information in. Thank you. And thank you for being a Founders Club supporter. I think you're the one of the only ones we've got in that tier. That's amazing. Thank you so much. Brandon says, I was reading yesterday, so since 2007, the Fed can buy bonds and equities by just creating bank reserves. It's wild. It seems like they do this to provide liquidity. Yeah, well, I mean, that's what QE is, right? They give the banks reserves and they buy their treasuries. They don't typically buy equities. That's not that's a line that the Fed has not been willing to cross. But we've seen at certain points they have tiptoed closer to it. So late in March of 2020, remember they had two FOMC meetings in March of 2020. There's normally one FOMC meeting every 6 weeks, but if you go look at the FOMC 2020. If you go look at the 2020 FOMC, you'll see that there were 2 meetings in March. Look at that. Well, there's a bunch of stuff in March, but really there were like 2 or 3 meetings. Oh, I see. Unscheduled meeting, and then this was the scheduled one. But during one of these, I think maybe it was this last one. I'm not going to dig through the notes to find out. But they announced that they were going to start buying corporate junk debt. And it was one of the ways of supporting the debt markets because some areas had gone no bid, right? Treasuries went no bid. And so during one of these last pieces of the March, the whole Fed pivot that was all of March, one of the last things they did was say, yeah, we're going to buy junk debt. And that was like, that put in like the pico low of the stock market. If you go look at the S&P on that day, let's go SP daily. This is stuff that you find out if you play around in the markets long enough. You just go look, hey, what happened on that date? This date right here, the bottom of the market was March 23rd of 2020, right? And keep in mind, this was after a minus 35% month. 1 month, the S&P fell 35%. That's insane. And the absolute pico low was March 23rd. That was FOMC. So the Fed literally bottom ticked the market in COVID, and they did so by buying junk debt. Ah. Alpha Beta Soup, also to keep interest rates low so the government doesn't have to pay high interest rates on bonds. Yeah, so QE does help lower interest rates, but it's really not the Fed's job to manage interest expense. That's the Treasury's job. But they do work together, right? They're independent bodies, but they work together as two arms of total US, you know, money policy. So yeah, it's really the Treasury's responsibility to manage interest expense. It's the Fed's job to manage the rate itself. Yellen's job to figure out how to pay for everything at current rates. You know, do I issue more long end stuff where it's a little bit cheaper? Do I issue a bunch of short dated bills where the rate is higher but it rolls over sooner and I can lower that rate? She has to figure out, that's her job. She has to figure all that out. Smooth operator, I just want to recognize that you don't get hiccups anymore. Hashtag progress. Well, you know, smooth operator, it's great that you are recognizing that I have not been getting hiccups as badly, but they do still happen every once in a while. It happened last stream and I just hid it because it didn't last that long. There was only like 2 of them and it went away, but I masked it really well. It hasn't happened yet today though. Maybe we'll escape today without one. If for those of you who don't know, I get hiccups like almost every stream. I'll be in the middle of talking and then it's all of a sudden just, you know, I can't, it happens every single time. So I don't know. It's funny. Anyway, all right. A few more things to talk about here. So I tweeted the other day that CPI looked like it was accelerating, and I'm going to show you some of those charts. So obviously the headline figure is around 3.2%, 3.3%. And it was 3.1 in January. It went up to 3.2 or 3.3, I think. 3.2 just like this past month. And if you look at Cleveland Fed, let me do inflation nowcast. Okay, so this is the inflation nowcast. This is an algorithmic prediction of CPI based on other data inputs and stuff like that. It's not 100% accurate, but it's pretty close. And it has been quite close ever since CPI stopped being up in the 6s and the 8s and stuff. When it was accelerating a lot and then decelerating from the peak, this algo was very wrong. But when the volatility of inflation is a bit lower, it's quite accurate. And what it's showing is that the year-over-year figure for March, which we will get in 2 weeks, is going to be 3.4. Well, we are at 3.2. And in January, we were at 3.1. So that is, if that's true, if March is 3.4 and we just had 3.2 and before that was 3.1, that is 3 consecutive months of year-over-year inflation rising. That is not what the Fed wants to see. Now, it's a very small amount. It's 0.1% compounded over each month. But that is a directional bias that the Fed doesn't want to see. We'll get into a little bit more of that here in a minute when I share some of the words out of Fed Governor Waller from yesterday, which are very interesting. But first, let's talk about this. So we got a bunch of different pieces inside the CPI. A lot of the talk around CPI is about how rent is coming down, and because of the calculation of rent, because it's like, how do you feel your price? What price do you think you would rent your home at if you were going to rent your home out? That's one of the ways they get the rent number. It's very lagged, and it's inaccurate, and it's been falling. Rent has been falling, and if you talk to CPI deflationistas, they tend to have the argument that rent and the lagging components there are the reason why CPI isn't at 2%. And if this just keeps falling, we'll just get there and it'll be no big deal, right? Because this is like a third, shelter is like a third of CPI or something like that. That sounds like a good argument. But then let's go look at the other components, right? So what you're looking at here on this page, and let me make it just a teeny bit bigger. What you're looking on this page are 3 different rates of change of CPI for 6 different categories. The red line is the year-over-year number. That's the usual number you hear from the media. Like when you hear the CPI report, you usually hear the year-over-year figure. It's 3.2. The orange line is the 6-month rate projected over a year, and the blue line is 3-month. So blue is the fastest, orange is the second fastest, and red is the slowest. So when you see blue picking up, you can expect it to bleed into the orange one after a couple of months. And if you see the orange line picking up, you can expect that it will start to pull up the red line, right? Because it is the slower of the three. And so what we're looking at over here, this is regular CPI, headline CPI, not much to see here. You see that the red line has come down and it's flatlined here basically since June of last year. CPI has been hanging out around 3%. And it's chopping around, but it's flat. But then let's look at median CPI. Median is just the one in the middle of the basket, right? We looked at some of this before, but I want to bring this back because of what Waller said yesterday. Median is just in the middle of the basket, right? It's the item in the center of all of the different things of CPI. And you can see acceleration here on a 3-month basis. It's over the 6-month rate, and the 6-month rate is over the yearly rate. So inside the basket, we have components that are increasing their rates of change over the last 2 or 3 months, and it hasn't yet bled into the year-over-year rate for everything, but it will soon if this trend develops and establishes itself. Trimmed mean, which is very similar, it's the average minus the most extreme things on the end. Look at the blue line, picking up pace, orange picking up pace above the yearly figure. It will pull the yearly rate higher. Core, same thing. Core services, which is inside of core, same thing. Shelter looks kind of flat, but it's stubborn around 5 or 6%. And interestingly, the year-over-year line is coming down, but in the last few months, the orange line here, which is the 6-month annualized rate of shelter, it has been picking up pace. It's been curling back up towards 6%. So it looks like inside of the basket, there are various pieces which have different weightings and different makeups, and their rates of change are picking up, and it hasn't reached the year-over-year number yet. It hasn't shown that number. It hasn't pulled that number higher, but it probably will sometime soon. And we're in a window right now where the Fed has said we're done raising interest rates. We would like to not raise any further. And if we just get a couple of inflation prints that go our way, we can feel comfortable lowering rates, even though we have tight labor markets, even though growth is above potential. We're going to go ahead and cut anyway. We just need inflation to cooperate. Well, if you look at 1, 2, 3, 4 of these 6 measures, core services, median, and trimmed mean, they're all accelerating. And if you look at the Cleveland Fed Nowcast, it says we're going to get a 3rd straight month of headline being higher. That's going to make it really difficult for the Fed to continue with their uber dovish talk, especially when you think about just how excited everyone has been in the last week since Powell spoke, right? Everyone just went nuts when he was super dovish at the last FOMC, expecting the Fed to YOLO into inflationary growth. That's what we talked about here on the channel. So I think that they're going to have their work cut out for them, and it will be interesting to listen to Powell's tone and how much he tries to maybe walk some of this back. If you think about his board, right, there's a whole board of governors. There's like 19 people in the Fed, and some of them vote on policy, some of them don't, but they're all surveyed on what they think the direction of policy will be. And entering into the Q4 of last year, most of the Fed governors were on the same page. They all tended to think inflation is coming down. Things are going the direction we need them to. Before long, we will be able to start easing policy, to start realistically talking about it. Well, in January and February, that tone has shifted. Whereas in November, December, it was much more accommodative, especially in December. But now there are multiple Fed governors all providing their opinions on rate policy, and they are split. They have diverged from each other. They're not all on the same page now. So let's look at a few of those headlines. Susan Collins, who is from the Boston Fed, she sees interest rate cuts coming later in the year. She's seeking more confidence. She said that over a month ago. I couldn't find a newer comment from her, but I bet we'll get one here pretty soon. She'll probably speak somewhere. John Williams of the New York Fed said the same thing. Rate cuts later this year. He wants inflation sustainably back to 2%. Well, maybe it's not doing that. So that's his view. Again, later this year. Goolsby, he's from the Chicago Fed. Goolsby said inflation hasn't fundamentally changed, and he sees 3 rate cuts. He's probably one of the most dovish guys, and he actually said that just a couple of days ago, which is really bizarre if you just look at this data here. And I just think it's interesting how all these Fed guys, Fed people, they're not all guys, come to different opinions when they use similar data. I always find that kind of interesting. But he says inflation's cooling off, 3 rate cuts, which is at the ceiling of Fed projections of rate cuts. Like that's the high end of rate cuts. A lot of them have started to pull back on that. Tom Barkin, he is from Richmond, Virginia, the Richmond, Virginia Fed. He says we have time to be patient. He said the data has been remarkable, but he wants to see broader and sustained disinflation. No one wants inflation to reemerge. Michelle Bowman, she is, I forget which Fed she is, doesn't matter. But she says it's too soon to cut interest rates. That was 1 month ago. She does expect inflation to keep falling. But she says she repeats a call for significant revisions to the Fed's capital plan for its plan to roll off its balance sheet. But she says she wants data to continue to indicate inflation is moving to 2%. I mean, that's their talking point. But it's an interesting. She thinks it's too soon, whereas Goolsby's like, yeah, 3 cuts, bring it on. And then Raphael Bostic, he's probably the most hawkish one these days, and he says 1 cut this year, sometime later this year. And he's come down. He had 2 cuts about 3 weeks ago, and he's now moved down to 1. He seems to be one of the few governors who's outwardly dialing back their expectations based on data that's a little more spicy than they were expecting. The other Fed governors don't appear quite be doing that. Which brings us to Christopher Waller. So Christopher Waller, Federal Reserve. I forget which Fed he's the head of. It doesn't matter. But Christopher Waller is one of the Fed governors. Oh, St. Louis. He's the St. Louis Fed guy. And he gave a speech yesterday. And it was pretty interesting for the caution that he's preaching to other members of the Fed, right? He's more in line with Raphael Bostic, who says 1 cut this year, who just came down from 2 cuts. And, if you look at Chris Waller's speeches, he's been kind of walking us through his thinking over the last couple of months. So he gives these speeches and they all have these titles. In October, as the data was weakening and he was starting to think that inflation was going the right way, labor was softening, and they're going to be able to cut soon, he was saying something's got to give, right? And they were expecting that they were reaching a breaking point. And then in November, he said, something appears to be giving. And that was him. And if you read the speech, he said, data's starting to support our outlook. We're seeing weakness. It looks like maybe we will actually be able to lower interest rates in the relatively near future as long as this trend continues. And then you fast forward to February, and suddenly his speech was called, "What's the Rush?" And in here, he preached caution. He said, well, actually, guys, maybe we're moving a little too fast. Maybe we need to price out some of these cuts, meaning we need to convince the market that fewer cuts are coming. And then yesterday, the newest speech says, there's still no rush. So we went from something's got to give to something appears to be giving to wait, what's the rush? To there's still no rush. So let's look through some of his comments here. We're not going to read this whole speech, it's quite lengthy, but I highlighted some sections and I'll give you my opinions. So he goes through a bunch of economic data. In here, he talks about labor, he talks about growth, he talks about consumer spending, productivity. He really covers the gamut. I've highlighted some of the points. The data we've received so far has made me uncertain about the speed of continued progress. Back in February, I noted that data on fourth quarter GDP and January job growth was hotter than expected. That was the speech, "What's the rush?" I concluded then that we needed time to verify that progress on inflation that we saw in the second half of 2023 would actually continue, which meant that there's no rush to cut interest rates. Over the past month, additional data has reinforced this view. So again, He went from something's got to give to something appears to be giving, which he's highlighting here. Progress we saw in the second half of 2023. That was him talking about it here. And then suddenly in February, the data's hotter. And he's saying, whoa, 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 what's the rush? Over the past month, additional data has supported this view. He talks about PCE being a little bit hot. Adding this new data to what we saw earlier in the year reinforces my view that there is no rush to cut the policy rate. Indeed, it tells me that it's prudent to hold the rate at its current restrictive stance, maybe for longer than previously thought, so we can keep inflation on a sustainable trajectory towards 2. I continue to believe further progress will make it appropriate for us to cut rates this year. But until that progress materializes, I'm not ready to take that step. So he's clearly saying, if the data cooperates, I can cut rates. But as we are looking at, and as he will outline in this speech, the data is not cooperating here in the most recent term, like the last 2 or 3 months. It's questionable how much it's really going in the right direction. And when you have a Powell come out in FOMC and be as dovish as he was, then that undermines some of these efforts. And he goes through some growth things. He talks about consumer spending being kind of high. He says GDP now predicts first quarter GDP of 2.1, which is down from where it was, but that's still really solid growth. And if you go look at GDP now, that's correct. It's come down from up at being at 3 or 4. It's now down at 2, but that's solid growth. That's basically potential growth. Then he goes through a few other things. Says, now let me turn to the labor market. This data is sending a mixed message. Recent gains have been broad-based. Gains in jobs have been broad-based across sectors rather than concentrated, which might be a sign that demand is not moderating as much as is needed to support inflation. Conversely, the household survey said that unemployment jumped to 3.9%. But that increase was because we had more 16 to 24-year-olds unemployed. Youth unemployment is volatile, so this rate could just drop back down, and if so, the unemployment rate will go back down as well. So he's not doing what the people on FinTwit do, which is a single data print comes in and he extrapolates it out into the future in perpetuity. He has recognized that yes, unemployment has risen. Yes, job growth, job gains have been in multiple sectors, but some of that is youth unemployment. And if that volatile data recedes again, because it chops around all the time, then unemployment will just go right back to being lower, and we won't be able to count that as a softening of labor conditions. Then he goes on, he says nominal wage growth has also continued to ease, but wage growth is still above the pre-pandemic levels. And if you consider total compensation, not just wages, but benefits too, growth is slowed down, but it's still high. And we've talked about that quite a bit on here, about how wages and CPI, wages and prices go together. They are intrinsically linked. And wage growth remains elevated. Almost any way that you measure it, it's still like 4%. And that's double the inflation target. That's much higher than it historically is. Usually we have 2 to 3% wage growth. So he's not wrong about any of that stuff. He talks a little bit more about job vacancies, and he says the job vacancy to unemployed rate is higher than what it was before the pandemic, which suggests that the labor market remains tight. So what he's talking about there is the ratio between job openings and unemployed people. So if you have more job openings than you have unemployed folks, it suggests that there's still a lot of demand out there for labor. They just might not be able to find skills that match with the roles they're trying to fill. And that's always the case. It's never the case that if you have 100 unemployed people and you create 100 jobs, that you fill all 100 of those vacancies. That never happens. There's always somebody who just can't fill the criteria of a given job's requirements, either physically or skill-wise or whatever. It doesn't match with what they're looking for. It's never 100% job coverage. But when you have outsized unemployed versus vacancies, that's a barometer for the level of demand relative to excess supply. So let's look at that historically. This is the ratio. Going back to World War I dug deep in the fucking archives for y'all for this. I had to reach out to Dario Perkins, who works at TS Lombard, because he created this data set that shows job vacancies all back over 100 years. And I got him to hook me up with this a little while back, and I pulled it out of the archives. This is showing the ratio of vacancies to unemployed. So when this value is rising, it means that you have more and more job openings relative to the amount of people seeking work that don't have jobs. When the value falls, you have much more unemployed and fewer openings. This is the area that we were in since World War II. This is World War II, this huge spike, because we had a ton of job openings and very little unemployed. The unemployment was like at record lows during World War II. And here we are today. Look at the value clearly elevated over the last 80 years of history, 3/4 of a century, and we're still up there, right? This is where we were in the last 20 years. We were down in this level. We were below a 1.0, meaning that we had less job openings than unemployed people for most of my lifetime, in fact. Where's my drawing tools? So I was born in the early 80s. This has been the ratio for my entire life. Here's 1.0, right? We've been under 1.0, meaning we've had more unemployed people than job openings for virtually my entire life, with a couple of rare exceptions. One of those exceptions was the late 90s, the Trump administration for, multiple reasons. And then here we are today. We're elevated. The job market remains very tight. That's what Waller was talking about when he talks about vacancies over the unemployed. It's an interesting metric to pay attention to. And then he starts talking about productivity. I'm not going to read all this stuff here because productivity is kind of like an economist metric. People outside of macro, they don't really, you have to explain productivity to them. Productivity is output per person, right? And so if you have higher productivity, it means that each worker is marginally producing more output. So you're getting more for what you're paying as an economy. And as he puts it here, when productivity across the economy grows, it means output and income can also grow quickly without putting upward pressure on inflation, right? Because output is you producing goods. So if incomes are rising, but you're also producing more goods, then you have more money chasing more goods, and inflation is net neutral, all things equal. But if you're not producing more goods, but prices are rising and incomes are rising, you have more money chasing the same pool of goods. So that's what he's talking about here. We have rising productivity, and we do have rising productivity. If you look at it on a year-over-year basis, it looks like this. It's picking up year over year. There are a lot of people having a debate right now about whether this means that we are about to begin a prolonged period of elevated productivity, which means that we have compounded increases in efficiency per worker while also maintaining tight employment so that rising incomes chase more goods and we don't have an inflationary effect. There's a lot of people debating that. We had that in the late 90s. You see this line chopping higher and higher and higher. This is a year-over-year figure. And for 5 years, it continually printed higher highs on a year-over-year basis. That's huge growth in productivity. If you look at it on an index level, it looked like this in the 90s, just nonstop growth. It doesn't really look like much historically, but this was that period, right? This is productivity today. It's been largely flat since COVID, and we just recently broke into a new high on an index level, meaning like on an all-encompassing level. So the growth rate has been picking up quite a bit. And the reason I think that this is so strong is because it pulled back so much. Right? And if you're growing from lows, you're going to have higher percentage gains. It doesn't mean that it's a new trend. It just means that recently productivity growth has been strong. But the Fed has to care about this because it has a relationship with inflation. So if productivity is going to rise and stay that way, then that will be a boost to their efforts. It will be net disinflationary, deflationary, whatever. So back to Waller's comments. He talks a lot about productivity. He lists a bunch of different things that people think are impacting productivity and why he doesn't know necessarily that those are long-term trends. Much of them seem to be very short-term things. And he gets down to this point. He says, okay, I'm going to be watching productivity. I'll keep my fingers crossed for more good news, but I'm not convinced that this growth will continue. So I'm going to keep that in mind as I form my judgment about the outlook. So he's not going to use productivity as evidence that they should ease sooner, that they're being supported by some miracle in the labor market. He's going to remain cautious, which is the approach that I would take on this because it's not clear that the trend has actually durably reversed. So let's continue on. We're almost to the end of his speech here, and we'll wrap this up. He talks about CPI quite a bit. He identifies things that we identified, things that we can see over here, that certain rates of change on 1 month and 3 month annualized rates just recently have started to pick up. In some cases, they're higher than the year-over-year figures, and that will drag those up. And so he's saying these shorter term inflation measures are telling me that progress has slowed and it might have stalled. That's not a good word right there. But we will need more data to know that. And it says it's appropriate to point out that a month or two of data doesn't necessarily indicate a trend, and there are good reasons to think that progress on inflation will be uneven, but likely to continue back down to 2%. At the same time, monetary policy is data-driven, so I want to take all of that into account. I don't want to overreact to 2 months of data, but I do think it's appropriate to react to it. So he's saying we should acknowledge this data, but just because things have picked up in 2024, we don't know yet. We can't say it's time to ease. We can't say we need to raise rates. So let's just not do anything. In my view, it is appropriate to reduce the overall number of cuts or push them further into the future in response to the recent data. This reflects the reality of managing an outlook in real time. Subsequent data might alter this outlook again, but we'll see. Based on what we know now, there's no urgency to take that step. I see output and labor showing strength, while the progress on inflation has slowed. And because of that, I see no rush in taking the step of beginning to ease. So Christopher Waller is basically saying we should not do this. We should not be talking about cuts. We shouldn't be pumping the market up to expect them sometime soon because we don't know where we're going. We have no idea what the path of inflation actually is. We can only read it in real time as it comes in and make guesses. And just recently, you have to acknowledge that it is picking up just a little bit. And if nowcast is correct, here it is. If the nowcast is correct, we're about to get our third consecutive month of a higher year-over-year figure. And we might even get a fourth one, again, if these trends are more durable. So the Fed is very split. We went through all the different governors and how some of them are calling for fewer cuts. Raphael Bostic says 1 cut. Chris Waller says, why are we talking about cutting right now? His speech is literally called "There's Still No Rush." It's going to be tough. It's going to be tough for Jerome Powell to justify bringing about a policy change because you need to think about it this way. It's not a simple decision of, well, we'll just lower the rate 1 tick and then we'll just wait again. And then, if we have to stop doing that, we'll just stop doing that. When you announce to the financial markets and to the economy and to the world as the Federal Reserve that you are now turning your direction of policy to one of easing, you're going to cut rates for the first time in 4 years. When you do that, you are not signaling a single wait-and-see cut. What that comes with is an implication of a package of rate cuts in the near future, over the next, 18 months or so. It's what the market is going to take that to mean. The next 12 to 18 months, we will see multiple cuts, and as soon as they do the first one, they're going to deliver more. And I think that when you take into account everything Waller just said, his hesitation, him seeing strength in labor, stubbornness in vacancies, inflation's picking up a little bit, wage growth and economic growth remain elevated. And he's saying, whoa, We don't have enough data to pivot our entire messaging. They've done so much work to get the market to this place where they are accepting of 5.5% rates in the present. And what do I mean by that? I mean, if we go look at financial conditions as we looked at together last week, financial conditions are easier now than they were when the Fed started raising interest rates. Yet interest rates are 550 basis points higher than they were on my red dot right here. And that's happened largely because of Janet Yellen and Jerome Powell playing around with liquidity, but also the Fed's job. They've done the work over the last 2 years with forward guidance by using the mouthpiece to drive the market to a place where it slowly became accepting of higher and higher interest rates without collapsing the economy. And if they're going to turn that boat now and give back the work that they have put in, they better damn sure know it's the right thing to do, because everyone is hyper focused on them right now, right? It's already taken so much work just to get the market to believe that there were less than 7 interest rate cuts this year. What did we talk about for the last 3 months on this channel? In almost every stream, we looked at the FedWatch tool and how many rate cuts were priced into the market, right? And we noted how each subsequent FOMC, it was coming down, down, down. And just recently, just finally, the market got to a place where it wasn't expecting 7 cuts. It's expecting something closer to 3. And that is what the Fed's dots showed in December of last year. So with the market this eager for cuts, and every cut is expected to be the beginning of a new bull run, a crazy melt up, with speculation being as rampant as it is, while economic growth remains pretty strong, and CPI has come nowhere near their target. It has been hovering with a 3 handle for since June of last year. And if we get to June of this year and they still have not posted a sub 3 CPI, they're in real trouble, like as a policy unit, to have to figure out how to manage that, how to walk the market through those expectations. So what I think they have to hope for is to hold policy, hope that maybe labor softens just a teeny bit more. Maybe we get one more tick up in unemployment. Maybe inflation actually cools down a little bit if Powell will just shut the fuck up for a little while, and hope that the pricing out of cuts itself brings financial conditions back down from the stratosphere of ease and to something a little more neutral, a little more normal. I think that's what they have to hope for. Raising interest rates again would be the wrong message to send. It would make it seem like they don't know what they're doing, and they would probably lose even more credibility unless we got a crazy data print of some kind, some huge inflation pop. But if, like I said, if they turn around and they ease policy, it has an implicit multi-cut package embedded inside of it. It's not one cut. And so they have to wrestle with that entire turn in mentality with the markets. And they have to remember that it's an election year. They've got to do this in an election year, in what will be a very hotly contested election. And who is going to likely be the GOP nominee? Donald Trump, who has already got a history of shit-talking Jerome Powell into doing things. And so if Powell eases policy and we see a pickup in activity, a pickup in inflation, if any of that doesn't go according to plan during an election year, he will be seen to be trying to support the incumbent. And I don't think that the Fed wants any of that attention, especially if we're about to get a new administration, because whoever comes in, probably Trump, they are going to be so fucking angry and not remotely cooperative with whoever is running the Fed if that's what happens. So I think that there are very real frictions against just waving the green flag in 2024 for Fed policy. They may still do it, at which point we grab our ass cheeks and we hope for the best. But I just see a minefield of risks, political risks, economic risks, financial risks, credibility risks. And there's dissent within the Fed itself. So that's what we should watch as far as the Fed goes. This next coming FOMC, and over the next couple of months, we watch the PCE data. We get a PCE report on Friday, which will either confirm or disavow some of what's been going on in CPI, and just kind of watch the messaging. The next FOMC will be fascinating because the last two have been quite dovish, and now Powell is starting to get dissent within his own ranks. All right, let's catch up on the chat. Code 9 gifted a membership. Thank you so much, brother. BCB, 2-month member of the Founders Club. You and XP Market are in the Founders Club. Thank you, bro. Huge supporter. Blockchain backer. That's my homie. Ryan Rendon, a member for 3 months. Thank you for sharing your charts and alpha. Your data and info helps things make more sense. I appreciate that, Ryan. I'm just trying to make sense of it for myself. Right? I don't come with a lot of sage wisdom I've earned from years in the markets. I try to learn things, and then if I feel like I've got a good handle on it, I'll try to explain it to you guys. And that's just how we just keep doing that over and over again. Andy Philpott gifting 10 memberships today. If you were gifted a membership from Andy, make sure you tell him thank you. He's one of the most generous members we've got here. An OG. He's been donating memberships since I started doing this a few months ago. If you have a membership, if you've got a green name, you can come to the member stream. I'm going to go ahead and book it now. We're going to do it at 12:30. It's now 11:58 a.m. So in 32 minutes, we're going to do a member stream. Let me go ahead and book that right now. And so that means we'll wrap this up here soon. And if you have a green name, you can come hang out with us in a little bit and we'll do a more casual thing. I won't be monologuing the whole time. If you have questions for me that don't get answered in the stream, I'll make sure to prioritize those. And we'll just get to know each other a little bit, be a little more casual. And we've been doing those about once a month for folks who are in the members group. You can be a subscriber to the channel and still watch the public stream as you are now. You won't miss anything. But if you'd like to come to a little bit extra piece of content, something a little more exclusive, consider becoming a member. Let me make sure there's not any outstanding questions in the chat here. I have a few things I want to talk about in upcoming streams, just to kind of give you guys a tease. So on Sunday, we did the first Sunday stream, and I think I will do another one of those this coming Sunday. And what I think I'll do, I don't know if this will be forever, but I think what I'll do on Sunday is we will do a little bit less market analysis and do a little more qualitative kind of history discussion. I want to show you guys some lessons from history, some interesting things that I've read and how I think that they relate to what's going on today. Just kind of have a more chill kind of Sunday stream where we do a little more historical learning, more of like a big picture framing of this era that we live in of human history and how its parallels might exist in the past. That's stuff that I think a lot about. I spend a lot of time reading things and highlighting stuff because holy crap, that sounds like today. And I just think it'd be interesting if maybe I can force myself to get some of my thoughts organized around that. And we spend a casual Sunday stream talking about some of that stuff. So that is what I'm tentatively planning for on Sunday, because I have a lot of things that I want to talk about with you guys, but it's really hard to come on here every week and tie some of that stuff into what's going on in the market, right? Like if I read some cool thing about how China ended up in the great financial crisis, I don't necessarily know how to tie that to like the Bitcoin chart and what's going on with the Fed and everything, but it's still interesting and I still want to talk about it. So, it makes sense to maybe separate it just a little bit from the more active and timely analysis that we do on the midweek public streams. So that's just kind of my thoughts around what we'll do on Sunday. The one we'll do here in about 30 minutes will just be casual. We'll just hang out and shoot the breeze and get to know the homies a little bit. And I can show you guys whatever it is that you want to look at behind the curtain. But Sunday, we'll probably do kind of like a fireside chat kind of stream. So tune into that if you want to. Brandon says, guys, it's a melt up. Yeah, it could be. It could be. If it's a melt up, it's a pretty low volatility melt up right now. This is just a very low vol grind, a weird melt up. It's interesting because the Mag 7, man, they're just performing all over the place. You know, they're not really a Mag 7. I use that term because everyone knows what it is, but really it's like the Mag 4. And then there's like 2 or 3 others that are kind of doing their own thing. Really weird mix of performance at the top of the market. And I think because a lot of these names have led a lot of the progress, like look at what Apple did in November and December. Look at that. That's just an insane squeeze. That is a complete reversal of positioning in a very short period of time. I think they're just kind of exhausted. Maybe we get to see some continuation out of the Russell and other areas of the market. Maybe they do a little more work, or, you know, maybe this is the alt season as the mega caps are pulling back and this is the last gasp of the stock market. I mean, I don't know. I still maintain a general recession expectation, but I've had to loosen it up a little bit because it hasn't manifested, right? The data is still growing. Labor still hasn't broken. The economy still has positive GDP. So even though we're in the window when things happen and rates of change all over the place look really concerning, I have to acknowledge reality. And reality is so far there's no recession. But we could still get one. And there will be signs. So it's important that we watch for those signs, even though things are going well. Yeah, Russell expansion would be nice. But all right, we're going to wrap up this stream here and give you guys about a 20-minute break before some of those green names come and join me for a little private member stream right after this. It should be on your timeline if you want to hit the reminders. So look on that on your YouTube timelines. But thank you for being here today. If you've not hit the like button yet, please do so. That's the easiest way for you to support the channel. Next week, I'll be traveling. So I think the next midweek stream will probably have to be on Friday. I'll try to send a post to my YouTube page with that information, if that's the case, so you guys aren't wondering. What's up, Oscar Santana? I see you there. What's up, CB? Zach Hessler? What's up, y'all? All right, gonna let y'all go. Been a lovely stream. I got a lot of things off my chest. We're going to see what happens with BTC. We're going to find out if it really did turn the prior all-time high into support. I hope that it did, because I've got a bunch of bags that I would like to get out of. I would like to reduce my spot exposure to the altcoin market. And for that to happen, I need BTC to just go a little bit higher. And then I will be glad to do that. But all right, until the next time we speak, which will be maybe a little over a week from now. Well, no. The next time we speak on the public stream will be Sunday. The next midweek stream will probably be Friday of next week, because I think I come back from my trip on Thursday or Friday. I'll let you guys know. And yeah, we'll just kind of keep rolling here. Thank you so much for being here. I appreciate it. Make sure that you call your mom. Go outside, enjoy the weather. Right? Don't sit at home and stare at the charts all day. I have a real bad problem of sitting at home and looking at charts for 9-10 hours a day and then wondering why I'm exhausted. Make sure you don't do that. Be better than TX. We'll chat again in just a few days' time. Looking forward to it. Thank you for your support, everyone. And I'll see you member homies in about 25 minutes. Thanks. And cheers, everyone.